This video is for educational purposes only. It's designed to help you understand how market crashes work, not to tell you what to do with your money. When the stock market crashes, billions of dollars seem to vanish overnight. News headlines scream about trillions lost. But here's a question that puzzles most people. Where does all that money actually go? Does it disappear into thin air? Does someone else take it? The answer is simpler than you think, but it reveals something fundamental about how money and value really work. Let's break it down step by step. First, let's understand what a market crash actually is. A market crash happens when stock prices drop rapidly and significantly, usually 10% or more in a very short time. Sometimes it's a single day, sometimes it unfolds over weeks. But to understand why this matters, you need to know what a stock price really represents. When you own stock in a company, you own a small piece of that company. The price of that stock is simply what people are willing to pay for it right now. Think of stocks like houses. If you bought a house for $300,000, you don't actually have $300,000 in cash. You have a house that you believe is worth $300,000 based on what similar houses have sold for recently. Your wealth is on paper, not in your bank account. And this is where things get interesting because most wealth isn't actually cash. So when a market crashes and billions are lost, what's really happening? The money doesn't go anywhere. It was never really there in the first place. Here's a simple example. Imagine you buy a share of stock for $100. A year later, that stock is trading at $150. You feel $50 richer, right? But you haven't sold the stock. That $50 only exists as an idea, a valuation based on what someone else might pay you. Now imagine a crash happens and suddenly that stock drops to $80. You've lost $70 from the peak, but that $70 never existed as actual money. It was potential value, and potential value can disappear the moment people's opinions change. Think of it like a painting. If an art expert says your painting is worth $10,000, you feel wealthy. But if another expert says it's only worth $2,000, you didn't lose $8,000 in cash. The painting is the same, only the perceived value changed. This explains the first mystery, but it raises another question. Why do these opinions change so quickly? During a crash, stock prices fall because more people want to sell than buy. It's basic supply and demand. When fear spreads, everyone rushes to the exit at once. Imagine a concert venue with 10,000 people. During the show, a few people near the back decide to leave early. No problem, but if someone yells fire, everyone rushes for the exit simultaneously. It doesn't matter if there's actually a fire. The panic itself creates the crisis. In markets, fear works the same way. Maybe a bank fails, or economic data looks bad, or a global event creates uncertainty. A few investors sell, others see prices dropping and worry they'll drop further. More people sell, prices fall faster, even more people panic. Within hours or days, you have a full crash. The stocks themselves, the actual companies, often haven't changed. A company that makes cars or software or coffee is still doing the same thing on Tuesday that it was doing on Monday. But the price people will pay for a piece of that company has changed dramatically. And this is what separates what happens to stocks from what happens to actual companies. When stock prices crash, the companies behind those stocks usually keep operating. A lower stock price doesn't mean the factory stops running or customers stop buying. However, companies do face real challenges during crashes. If they need to raise money by selling new stock, they'll get less for it. If they need loans, banks become more cautious. Consumer confidence often drops, so people spend less money, which hurts sales. Some companies, especially those with a lot of debt or those in struggling industries, can fail during crashes. They run out of cash, can't pay their bills, and go bankrupt. This is real destruction of value, not just paper losses. But many solid companies survive crashes and eventually thrive again. They still have their factories, their employees, their customer relationships, and their products. The panic eventually passes. Here's something that surprises people. Cash becomes more valuable during a crash, not because the dollar bills themselves change, but because of what they can buy. If stocks are falling, the same $1,000 in cash can buy more shares than it could before the crash. Cash gives you options when others are desperate. It's like showing up to a garage sale with money in your pocket while everyone else is trying to sell their stuff to pay bills. This is why you'll hear about certain investors buying heavily during crashes. They've held cash specifically for these moments when good assets are selling at discount prices. But the real question is, what happens to actual people? For most people, a market crash affects their wealth on paper, especially if they have retirement accounts or investments. Someone with $100,000 invested might see their account drop to $70,000. That's stressful to watch, but if they don't sell, they haven't actually lost money. They still own the same number of shares. The people who get hurt most are those who need to sell during the crash. Maybe they were planning to retire next month and need that money to live on. Maybe they have an emergency and need cash. These people turn paper losses into real losses because they're forced to sell at the worst possible time. On the other hand, some people lose their jobs. When companies struggle and the economy weakens, layoffs happen. This creates real hardship, even if someone wasn't invested in the market at all. Crashes also create a psychological impact. People feel poorer, even if nothing in their daily life has changed. This fear makes them spend less, which slows the economy further, which can make the crash worse. And this brings us to why some people recover faster than others. The people who recover fastest from crashes tend to share certain characteristics. They have emergency savings in cash, so they don't need to sell investments at a loss. They have stable income sources that continue through downturns, and they have time on their side, meaning they don't need their invested money for many years. Those who struggle most are often the opposite. No cash reserves, lost their job, or need their invested money soon for retirement or other major expenses. This is why, throughout history, market crashes have sometimes widened wealth gaps. Those with resources can weather the storm and even buy assets at discount prices. Those without resources face tough choices and forced losses. But there's also a pattern in history worth noting. Markets have always eventually recovered. The 1929 crash, the 1987 crash, the 2000 dot-com bubble, the 2008 financial crisis. Each time, markets eventually climbed back and reached new highs. This didn't happen in weeks or months, but over years. Market crashes aren't new or rare. They're a regular feature of financial markets. On average, significant market drops happen every few years and major crashes every decade or so. What changes is the cause. Sometimes it's a banking crisis, sometimes it's a bubble in technology or housing, sometimes it's a global event like a pandemic or war. But the pattern is similar. Rapid rise in prices, growing optimism, then something triggers fear, and prices fall rapidly. Each crash feels unique and terrifying to the people living through it, but from a historical perspective, they're part of a cycle. Growth, overconfidence, correction, fear, recovery, and eventually growth again. So what actually happens to money during a market crash? The truth is, most of it doesn't go anywhere because it was never really there. It was perceived value written on screens and statements based on what people believed assets were worth. When that belief changes, the numbers change, but the underlying companies, buildings, and resources often remain. Real harm happens to people who are forced to sell at the wrong time or who lose jobs during the economic slowdown. Real opportunity appears for those with cash and patience, and throughout it all, the cycle continues as it always has. Understanding this doesn't make crashes less scary, but it does make them less mysterious. If you found this explanation helpful, consider subscribing. We break down complex financial topics into clear, simple concepts that anyone can understand.